The stock market doesn't care about geopolitics. The stock market doesn't care about politics. The stock market cares about earnings. We don't need the Fed to cut rates here, right? Real GDP is probably going to grow 2.5%. Economy strong, consumer resilient, right? Oil prices, gas prices coming down quickly here. I think we're fine.
What are the biggest risks facing markets right now? Well, how do we navigate these risks as investors? And is this a buy the dip opportunity or the start of a bigger sell-off now that we've seen some rotation out of risk and some flushing out of speculative capital? We're going to find out. And we're going to also find out what the most overvalued sectors are and whether or not we should be shorting these sectors or just staying away. Our next guest is going to answer all of these questions and much more, including what to expect from the Federal Reserve following heightened inflation expectations. He is Chris Galipeau, head market strategist at Franklin Templeton, and he's had over 30 years of investment management experience, spanning quantitative and fundamental analysis on both the buy side and sell side. This video is brought to you by Kalshi. It's the largest prediction market in the United States. Unlike a sportsbook, you're trading peer-to-peer on real-world events, from economic data to political outcomes, and the price moves based on public opinion, not a house. Go to the link in the description down below or scan the QR code here to get started. And new users who use my code LIN, L-I-N, will get $10 when you start trading $10. Right now, there's a trade going on called jobs numbers in June 2026, where traders are predicting what the next jobs report is going to look like. Right now, there is a 70% chance that the next jobs report to be released tomorrow on July 2nd will be above 100,000 jobs. And if you do place a trade on that, let's say $50, and you turn out to be right, your payoff could be $70. Chris is actually going to talk to us about his expectations for the next jobs numbers and what he expects the economy to do overall in Q2 and what he expects earnings to do in Q2. Earnings season is coming up. So Chris, welcome to the show. It's good to see you.
David, thanks for having me.
Currently, right now, as we're speaking on July 1st, happy Canada Day, by the way, to those of us watching in Canada. The S&P is relatively flat. The NASDAQ is slightly down. Gold is having a bid, up 1.2%. Bitcoin is retracing above $59,000 again, up 2.5%. And Treasury yields, the 30-year yield is up 1.1% now. So bonds are down, gold's up, and stocks are flat. Right now, it looks like there's been a bit of a rotation away from tech stocks into other defensive sectors over the last couple of weeks as the IGV software index has been falling a little bit. That's just a bit of a recap for what's going on today in the last couple of weeks. Would you call this a rotation out of risk assets? Is that the current environment we're living in right now as we speak on the 1st of July?
I don't think so, David. I think you've got, in terms of semi space, you've got a very extended basket, huge move here year to date. They need, those stocks probably need to take a break. Fundamentals are solid, but they need to take a break. On the flip side of that, you've had the hyperscalers and the Mag 7 guys really struggle this year, down into today, 174 basis points, so red, and that's 12% behind the S&P. Those stocks are probably bombed out, sold out. They probably should rally, and semis ought to take a break. I think that's really what's happening here. And under the surface, today, new all-time high equal weight S&P, new all-time high mid-cap, new all-time high Russell 2000, new all-time high Russell 1000 value. Market's broad, market strong.
Yeah, mid-caps have been catching up to the large caps this year. Is that the play here? Small and mid-caps, Russell 2000 versus S&P?
It's been the play for a year and a half. We got on that train, published a paper in January of 25, and that was really the call. And the call was, look, we think the stock market's going to broaden in the United States because earnings power is beginning to broaden. Stocks follow earnings over time. We're going to shift here from, an environment where Mag 7 dominated the playbook from 2020 to 2024 into something that's much broader, much more participatory, driven by earnings, and that is exactly what's happened.
Speaking of earnings, the stock market has primarily been driven by earnings is one narrative. What are you expecting for Q2 releases?
I think Q2 is going to be pretty good, David. Q1 was plus 25% year on year. The consensus was plus 12 or 13. So the actual report was 100% better than street, consensus. It was above what we had expected too. The estimate for Q2 is north of 20. We're expecting something north of 15 year on year, and I think we're going to hear a lot of the same rhetoric, right? We're going to hear from the big banks to start it off. They're going to talk about the economy being resilient, talk about the consumer being resilient. I think we're going to hear more from companies in all sectors and all industries up and down the cap stack about using AI to increase productivity and profitability. And that's really what we've heard for the last couple of quarters. I would expect to hear basically the same message.
It looks like a lot of speculative money is rapidly getting flushed out of crowded trades right now as we speak, though. So are there any specific subsectors within the tech space that you believe are finally reaching attractive valuations down from overhyped levels?
Mag 7, large cap growth, right? I know that's kind of a broad statement, but
yeah,
that area, yes. The speculation, to me is in semi space. Look, I get the fundamentals. We don't need to argue about that. They're strong. But when you have real, true parabolic moves, which you have in semis, look at the speculation there with levered ETFs, margin debt, that sort of thing. That's real. That needs to come unwound, and the froth needs to come out. And, it's starting, right? It's been really volatile there for the past 2 weeks. That's a warning sign. And hopefully those stocks pull back and give people a reasonable spot to enter.
Looking beyond immediate market volatility, there are growing questions around the sustainability of tech Capex and how high ROI can be sustained. Now, do you think that Capex, first of all, two-part question, has been the primary driver of not just the economy, but also the stock market? And if that's the case, we have to ask ourselves, when does this music stop?
Yeah. I think it's probably got a couple more years to go. You're right in that, big tech Capex spend has driven a lot of GDP, right? But it's been real. I think the question around discernible ROI from all this spend is the question right now. We've heard from major companies that your listeners know: Walmart, Home Depot, JP Morgan. I can rip off a list of 15 other names that in the last quarter or two or three have told us how AI has helped improve efficiency, improve productivity, so on and so forth. So we're going to hear more of that. And at the same time, in Q1, go back and listen to Amazon's management team or Google's management team. They showed us the proof that Capex is beginning to have an impact on revenue acceleration. So I think we should hear more from both of that. And I think the story around the hyperscalers blowing through all their FCF generation to spend on Capex is what's put these stocks in the penalty box, for at least the last 6 months. They've underperformed the S&P for the last 16 months. So I think that is well known at this point and probably reflected. And the reason I think those stocks have a chance here is you've got the basket, the Mag 7 basket, on a forward multiple basis, trading well below its 10-year median. Now, valuation doesn't mean the names need to go up, but you've still got pretty good earnings growth stories there, and the multiples are attractive. And I think people forget this, that when stock prices come down, so is the risk in owning the stocks, right? And that is at play here, I think, right now.
Well, let's just take the SpaceX IPO as an example to illustrate that point.
Yep.
At $135 share at the IPO price, how do you evaluate if that's risky, quote unquote, or not? Like, what's the decision-making process there?
Yeah, really difficult, right? So in order to buy, this is not an endorsement for SpaceX or a complaint against it, but in doing the fundamental analysis on a company like that, you have got to be willing to own the stock for 5 or 10 years, and you must believe in what they're trying to do, i.e. orbital data centers, right? Primarily driven now revenue-wise by Starlink, but expanding into orbital data centers. And you've got to believe in Musk, right? Who is he's brilliant. He's a disruptor. And, but you want to build a pro forma income statement for that company? Good luck, right? Because it's very tough to have any visibility out, past a year, never mind 5 to 10. So you're betting on Elon.
There's a suite of really exciting products offered at Franklin Templeton, and I like to look at these large fund managers and ETF issuers as a gauge of what market sentiment is and what consumers and investors ultimately want. Can you tell us about some of the recent offerings and the direction that the asset management industry is taking currently?
So I think what we've seen a lot of, David, in the last 6 months, maybe 12 months, is opening up the doorway for retail investors to invest in private markets, right? That's captured a lot of the bandwidth here in the last year. Franklin Templeton is a major global player in that space as well. So I think that is really exciting. There's been a lot of talk and a lot of enthusiasm from our client base in the United States around direct indexing, around tax loss harvesting and generating tax alpha. Franklin Templeton's got a world-class product there. The name is Canvas. But I think those are probably the two areas that I would cite in terms of products coming to market that are very useful, assume they're used in the proper way.
Okay. Right now, all eyes are still on the Strait of Hormuz closing or reopening, and that has an immediate impact on inflation expectations, which affects many things, including consumer confidence, consumer spending, and importantly, what the Fed may do depending on how inflation data actually moves. As a fund manager, how important are you tracking that area, or how closely are you tracking that area right now? It's already been more than 100 days since the start of the Iran war.
So, of course, we're aware of it. By the way, WTI here before we hopped on has got a 68 handle. That's back to levels before the conflict started. So that's the first thing. It's been a round trip. Here's the second thing, and the most important thing. If you look back to the Great Depression, so 1929, and you look at every major geopolitical event, wars, acts of terrorism, bubbles like GFC, black swans like COVID, presidential assassinations, all the wars, as I've mentioned. Here's what you will see: that the stock market probably reacts in the immediate term when something comes up, like Iran, like tariffs even. And then slowly, over 3 months, 6 months, and 12 months, the S&P 500 is up on average about 12% with a 75% hit rate. And the reason for that is the stock market doesn't care about geopolitics. The stock market doesn't care about politics. The stock market cares about earnings, and stock prices follow earnings over time. So if you think about what we saw in Q1, you get some consternation about the Middle East, natural. Market trades down 8 or 9%. Right? The market knows Q1 earnings are going to be good. It rallies and doesn't look back, 20+%. Stock market has had enough of the Strait of Hormuz. It's had enough of thinking about it. And it's more focused on what really the variable that matters, which is earnings growth. And that's always the case. But the issue is it's difficult in the moment because the media machine hypes it up and hypes it up and hypes it up. And you've got to be focused on what you know works over time, which is fundamental analysis.
Yeah, earnings drive markets. So let's take a look at what Bank of America might say in the next earnings call. Just take a look at what the big bank is using as a sentiment gauge. Here's a prediction market. Traders are predicting 53%. The word tariff will be mentioned, 18% World Cup. Pipeline, 50%. More markets here. Rate cut, 76%. Yeah. Cash Pro, 72%, buyback, 60%. It's interesting. This is just a gauge of some of the themes that we can expect in Q2 earnings calls across the board. And Merrill, okay, Bank of America is probably just one such indicator. What are you expecting CEOs to be concerned about in Q2?
I think what we're going to hear from the banks, David, as they start Q2 earnings season off is probably very similar commentary to what they've given to the street for the past year, which is the economy is strong, the consumer resilient, despite some headwinds. They're going to talk about their loan books. They're going to probably talk about delinquency rates improving, NCOs improving. So their private loan book in good shape, their loans to consumer and industrial space in good shape. They're going to talk about the M&A pipeline is robust. We just saw SpaceX. We're probably going to see other deals on a go-forward basis. They're probably going to start to announce buybacks. So we just saw the stress test, right? JP Morgan's on the tape with a buyback and a couple others. I think they're going to talk bull about the economic backdrop and about the consumer. I think that's critical.
Is the consumer in good financial strength, though? We're looking at savings rate declining. St. Louis Fed is reporting that the 60 or 90-day late delinquencies on credit cards are rising, and also delinquency rates on credit cards are rising overall. Of course, historically, there have been higher levels in the past. I'm just saying that the trend right now is higher. What do you make of these trends here?
I think that there's been pressure on the low end consumer here for the last couple of years. I haven't looked at that data, so I don't know exactly what it says. But okay, so looking at your screen here,
large bank consumer credit card balances 90 or more days past due rates, rising from a historic low in past COVID, 2021 now. I guess one could argue it's just normalizing, but if you just look at this trend in isolation over the last couple of years, it could be kind of concerning.
Maybe. I think if I had to guess, David, that's probably slanted toward the lower two deciles of income earners. I can show you a lot of data that shows you the reverse of that, i.e., cash on hand and net interest as a percentage of cash on hand. But everyone wants to talk about the consumer. Consumer confidence and the different measures that you can look at, they have zero predictive power. In fact, they're contrary tools. If you look at when consumer confidence or investor sentiment is low, the stock market actually goes up. Instead, look what they do. Look at the retail sales data year to date. It's been fine. Right? It's been fine. So unless we get into a scenario where the unemployment rate starts to go up, which doesn't seem likely, but if that were to happen, then you're talking about a different game.
Mm-hmm. In the notes that you sent to me offline, you said that there are some names that have gotten ahead of themselves and warrant a pullback. What are these names?
Semiconductors. All of them.
All of them. All right. Not just one, but all of them. Now, have they gone up because they have just been best of breed companies, and so investors are willing to pay a premium for that price? I mean, markets ultimately are a discounting mechanism, and if people are willing to pay the price, it's probably for a reason.
Yeah, right. And the time to enter those stocks was 6 or 8 months ago, not 6 or 8 hours ago, days ago, or weeks ago, right? In the case of take Micron or SanDisk that are up multiple hundreds of percent year to date, the move started well before that. So look, fundamentally, there's no arguing. I mean, Micron's report 2 weeks ago, as a large cap growth PM for a long time, that was one of the strongest reports I've ever seen. And I mean on every single line item, revenue, margins, profitability, net income, earnings. And the guidance was phenomenal on a go-forward basis, right? So all of that's great, but all of that's known and noble. Let me ask you this. What's the next catalyst to make that stock move another 20% higher? What does it have to be, right? So I think a lot of good news is probably reflected there and warranted. I just think the stocks need a break. There's a big difference between the fundamentals being, strong and making money in the stock. They're two separate things.
After what happened with Broadcom, a lot of investors don't even know how to interpret earnings. And we've been talking about earnings reports all day here. Broadcom cratered 16% in a month. The sell-off, just to recap what happened here earlier in June, the selling started in earnest after Broadcom's Q2 2026 report. Even though the numbers were strong by almost any measure, revenue came in at $22 billion, up 48% year over year. AI semiconductor revenue jumping 143%, so on and so forth. Yes, the numbers were good, and the stock still fell. So we're talking about earnings. What do you make of what happened with Broadcom? How can we use that as an example with this market overall?
Stock up big in advance of the news. You get the good news. People take money off the table. It's exactly the scenario I just described with Micron. The same thing happened in Q1 with NVIDIA. And it's not just, semiconductor centric. It can be any company. Stock price has a big move, doubles, triples, or whatever the order of magnitude is. Then the news comes out that, as you just said, David, the stock market is a discounting mechanism. It knows. And so when everything that's known and noble is reported, what's the next catalyst? And that's normal. That happens all the time. And people shouldn't be worried about it. It's just a normal thing. But just because a company reports a blowout does not mean the stock is going up. Look at Nike last night. Lousy on every metric. Stock's up 4%. All the bad news probably priced in.
Let's take a look at the Fed now. They look at inflation expectations or inflation data overall and the unemployment situation. Let's talk about inflation first. What measures do you look at? What indicators do you look at for a gauge on inflation expectations?
All right, so look at a couple things. Obviously, core PCE, which is the primary tool or the primary measurement tool the Fed uses, That's what we use. So our forecast for this year for core PCE is 3.3. Warsh just guided us to that exact number 2 weeks ago. As we wait here, I watched 2 additional indicators primarily, and what I'm going to describe here are the market-based proxies that help me try and get a handle on what the Fed is likely to do. Right. So 2-year note yields. Number one, 2-year note yields have a very good history of predicting Fed policy in both directions, hiking rates and cutting rates. So right now, as we're sitting here, 2-year yields are about 50 basis points above the effective federal funds rate. That suggests the Fed is likely to hike rates, right? Fed fund futures market is pricing a hike in December. Juxtaposed to that is what we see in the break-even market, which is the bond market's real pricing of inflation. Look at 1-year break-evens, for example. They've gone from 5.5 in March, start of the war, and oil at $1, to 1.5 today. Same's true in 2 years, same's true in 5 years. So this conflict between 2-year note yield saying, hey, you should raise rates, and break-even rates saying, hey, don't do anything, is a little bit odd. And I don't know exactly how that's going to get rectified. Our guess is, this is just our best guess, is they do nothing here, at least in the near term.
If the 1-year or 2-year or even 5-year break-even rates start rising considerably, do you change your stance on anything?
No, I mean, because that data moves like crazy, right? 1-year yields just went 5.5 to 1.5 in 3 months. So if 2-year yields trade 4.5, they're going to raise rates.
Yeah. Well, the Fed has adopted, under Kevin Warsh, they've adopted a new trend strategy versus looking at individual data points that come out every single month. So instead of that, they're looking at overall trends, is what they said at the last FOMC conference. Does that mean they'll bypass a few data points that we'll see this month, do you think?
Warsh was talking this morning, David, over in Europe, and I didn't catch all of it, but he was talking about how, he formed these 5 different task forces. And what he's talking about is improving the data collection, right? Including the timeliness of it and the robustness of it in order to give the Fed and the decision makers more timely information, right? And to help direct Fed policy. So I don't think they ever overreact, underreact to 1 or 2 data points. But my hope is that if they can get this right and they've got more accurate data, that feeds through to a better way, to use Fed policy and use their tools. That's the hope. And, he sounded a little less hawkish this morning, I thought, versus our first look at him. But he did reiterate no forward guidance. And I think they're going to work on this project. And hopefully it's helpful. Look, the data that the government gets and gives to us is useless. It's rear view mirror. It's, has to be revised 3, 4, 5 times. That's why, using macro sort of work to think you're going to be accurate in the stock market, to me, is a non-starter.
Okay, well, let's take a look at jobs numbers coming out this week. Economic data, starting with jobs numbers. So prediction markets are predicting a 69% chance above 100,000. If you take a look at tomorrow's employment report, the consensus forecast is 115,000. The last report actually blew the forecast out of the water completely. And now expectations are going to be even higher. So even if up 150,000, there's a 41% chance. Anyway, it looks like people are very optimistic about where the labor market is headed. If we got 2 strong reports in a row, that might set a trend. What's your expectation?
I would generally agree with that. I mean, JOLTS data told you, strong labor market here. The ISM data yesterday also north of 50, right? That's a diffusion index. Economy's strong. My guess is we have an in-line to slightly higher number. And what I'm really interested in, if that's the case, is back to what we just talked about. I want to see what 2-year and 10-year yields do coming out of that number tomorrow.
Are we in an environment where good news is going to be, I guess, bad news for markets? If, let's say, we have very good, strong jobs reports tomorrow on the 2nd of July, would that indicate to you more hawkishness from the Fed, which could actually put downward pressure on markets?
I don't think so, David. I think that if the number is, in line to stronger, then I think good news is good news. We don't need the Fed to cut rates here, right? Real GDP is probably going to grow 2.5. Economy's strong. consumer resilient, right? Oil prices, gas prices coming down quickly here. I think we're fine. I don't think, this is just my personal opinion. I don't think they need to do anything. And I think good news should be portrayed as good news.
Okay. What would happen
not
if
overheating, right? Let's put it that way.
Yeah.
The economy is not overheating.
I wonder why is it the American economy doing exceptionally well compared to its peers? Canada has been in a recession. Technically, the last 2 quarters has been negative in terms of real GDP growth. Europe's growth is Europe is pretty big, but overall, the EU's growth is pretty stagnant compared to the US. Is capital just flowing to the most competitive market right now, or is there something fundamentally stronger with the American economy compared to its peers?
I think there's been something fundamentally stronger with the US economy since its inception. I mean, I think about the 35 years I've been at it, the European economy has never really grown. There's not a lot of earnings growth there. All right. That's why the multiple is low. You flip that around, you think about the US, this is where not all, but the lion's share of the growth and innovation is, the best management teams in the world. You probably got a Fed that's certainly been very active right in the last decade or so. That helps. But I think you put all that in the soup and you've got the most prolific management teams and the most prolific and growing economy in the world is right here in the US.
And yet, despite this, you have very well-known investors, right? Bond King Jeff Gundlach saying the sell America trade is now in full force. At the core of his comments is growing concern over America's swelling debt load. There's an awareness now, he says, that the long-term treasury bond is not a legitimate flight to quality asset, warning that a reckoning is coming. He's referring to recent volatility in long-dated government bonds like the 30-year treasury. His firm has been putting its money where its mouth is. The Double Line CEO said his firm has been allocating more funds holdings to foreign currencies and recommended that investors broadly start to think about boosting non-dollar denominated holdings. What's your reaction to this?
When's the last time he's been right?
I don't know.
When's the last time Ray Dalio's been right? They've been talking about the same thing for a long, long time. I respect those guys, and I think Gundlach's a great thinker. But I have heard, the predicted demise of the U.S. and the debasement of the dollar, and no one's going to buy U.S. assets my entire career. It has never happened.
Why does that narrative still circulate, though, despite the fact that data has proven in the last 30 years it hasn't happened to the same extent that people have predicted it would be?
That's a darn good question, David.
Yeah. I mean, are you just taking a look at how far the debt is going to go? Are you concerned that the bond vigilantes are going to start taking action and start driving up yields?
I think what we watch the treasury auctions, of course, when they happen, there really hasn't been any demand softness there. If that were to happen, perhaps that would be something to worry about. If you look at the treasury tick data, by the way, for the most part, overall, it doesn't support that narrative that foreign investors are fleeing U.S. assets. It might be true for a couple countries, but it's definitely not true overall. I just don't buy that. I never have. I'm open-minded about it. I'm willing to see it, but let's see the data prove it to me first.
Well, what would happen? Last question. What would need to happen this year to make you more defensive?
When you say defensive, what do you mean in terms of?
In terms of switching your stance to a less cyclical allocation, more towards defensive sectors and more risk off overall.
I think that we would have to. It could be a couple things, right? If the Fed started raising rates quickly and indicated to the market that this is the beginning of a new rate hike cycle for whatever reason, if that were to happen, that would start to thwart aggregate demand, put downward pressure on GDP, and start to slow the economy. What the playbook is in that stance actually is move away from anything that's cyclically oriented. So any sort of value strategy will suffer. Those companies will have substantial earnings degradation. What works, the playbook that works in a GDP slowdown, whether you're headed to recession or not, is to buy growth stocks in that backdrop. So that would be one thing, right? A Fed policy mistake, possibly. Or let's say the S&P trades 8,000 and the multiple's 24, and you think we're at peak rate of change in EPS growth. That could be one thing. But like you said earlier, the entire move here year to date, the entire move in 2025 is all earnings driven, all of it. The multiple on the S&P is lower right now than it was on January 1st. So as long as the earnings picture holds in and nothing comes along to really disrupt it, i.e. Fed policy mistake, then I think that we're okay. Now, that's not a Pollyannish view, right? We're up 10% in the first 6 months. Our target range is 7,400, 7,800. We're in the middle of that now. That's why I think you don't chase it here and you buy pullbacks. We'll get some, David, right? It's a midterm year. We'll get some vol this summer. Be patient and have your list ready.
Chris, you've been at this game for 30 plus years. What are some of the biggest misconceptions about investing that you've encountered in your career?
Well, I'll be honest with you, in the course of being an analyst and a PM, I've literally made every mistake you could ever make running money, picking stocks and running money. And so what I've learned through that is to try and block out the noise, trend lines over headlines. I don't get worried about the narrative. I don't fall victim or prey to like the doomsdayers that are out there constantly. What I look at is where is the stock market on a valuation basis? What does the earnings picture look like? Remember, as you're running money, you're building a portfolio brick by brick. Do I understand the companies? Do I understand the catalysts? What are the reasons for me to change my mind on the fundamental view, be objective and open-minded? But I think trying as best you can to take the emotion out of the game. I don't always succeed at that, David, right? It is an emotional game, but trying to think of it this way, right? You and I are the pilot and the co-pilot in a plane. We're flying from Boston to Paris. We're in rough weather. It's at night and it's foggy and we can't see. The only things we can do there is depend on our instruments, and we can't second guess the instruments. So you need to have some discipline and stick through that discipline when the water gets rough or when the visibility goes 0-0. And I think that's what I've learned over time is the most important thing.
And there is a trend or a tendency for investors to start shorting things as soon as they think something is really expensive. Like you mentioned, the semis are all due for a pullback. They've been overhyped. The time to buy was 6 months ago, not now. Does that mean we should be shorting that sector? We're just staying away. There's a difference here.
Yeah, there's a big difference, right? Having run long short money too for a long time, that's a completely different animal. I would say you can do whatever you want, but my advice to your listeners is trade in the direction you want. Make sure you use stop loss orders, good till canceled. Believe me, that will protect your capital.
Yeah, excellent. Thank you very much, Chris. Where can we learn more about your work?
I think the easiest way to get a look at how I'm thinking and what we're thinking generally, David, is to follow me on LinkedIn. There's a newsletter that comes out every week. It's short. You can read it in 30 seconds. I don't mess around there. I'm right to the point, I think, as you can tell. Follow me on LinkedIn. You can subscribe there.
Okay, well, we appreciate your candor and your directness, so we look forward to more of that in writing. I'll put the link down below, so please do check out Chris's writing there. Thank you so much, Chris. It was nice meeting you. I hope to have you on the show again soon. Take care for now.
Appreciate it, David.
And thanks for watching. Don't forget to like and subscribe, and don't forget to use my code LIN, L-I-N, when you sign up to Kalshi. Link down below or scan the QR code here. And remember, new users who use my code LIN can get $10 when you trade $10.